All right. I saved the most difficult for last, and this is the energy sector. And so let me show you my notes there. So it's right here. All right. So we're currently in ExxonMobil, and it is the worst performing stock that we have this year. I mean, I don't like to throw blame around, but um, you know, yeah, it is the worst performing stock that we've had, and so um, we have a choice. We either purchase more shares to get ExxonMobil at a cheaper price, or we sell ExxonMobil and we move into something else. Okay. Now, with that being said, um, Valero is um, Valero is their stock. Valero is in the return portfolio. That is where the software is pointing us. We've looked at this over and over again, and it is no doubt that the return portfolio has performed the best thus far from July 2019 to current. And so, what we want to do is we want to try to mirror those results. Okay, and these are the companies that were purchased in July of 2019, and this is their return thus far, including dividend as well as price appreciation. Okay, and so again, what we want to do is we want to mirror uh, this this portfolio, and so Valero is the company in that portfolio. Okay, so let's take a look. Again, just want to mention so we're currently in ExxonMobil. Valero is where we're being pointed to. SM, which is a company I don't know a lot about, but they are currently the best performing stock in the sector for the year. And so let me quickly show that and see what's going on. All right, so you see here, okay, make sure we get this sorted properly. Okay, so SM, just crazy numbers, okay, crazy numbers. Um, a lot of this comes from this 1 month in May, okay. I keep pointing back to May because May is when everything kind of just went crazy, okay. Let me show you what that looks like. So this is May 2020, okay. See, I mean, there is all this green all across the board, okay. And what this primarily is what's called a dead cat bounce, okay. Dead cat bounce. It's a stock market term that means that it's it's kind of morbid, but it's funny too, right? So if a cat were to fall, right, when it hits the ground, it's gonna bounce a little bit, right? It's not just gonna go splat. I mean, it's gonna hit the ground. It's gonna bounce a little bit, and so the term it's really I want to use a word, but I'm not sure how to pronounce it. I'm gonna leave it alone. But it's a really good term though, to illustrate exactly what happens in the market a lot of times, because you have these steep drop offs where you have everyone selling, 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 and what happens is people realize, like I said, market psychology. Oh my goodness, people have sold all these stocks and the prices have dropped down so far. Um, I'm going to try to make some money. I'm going to try to make some profit. I'm going to come in and I'm going to buy these cheap stocks with the hope that they're going to increase in price, which they usually do. That's the reason why we all know about the dead cat bounce. Okay. Um, Typically, when you have a dead cat bounce, those companies that do really well aren't doing really well because they're great companies. They're doing really well simply because they were either the worst of the worst that got sold off, or because sometimes they're just the cheapest, you know. And in this case, when we talk about SM, it's literally one of the cheapest. Okay, and what I mean by that is that SM is currently selling at $6 a share. So what that means is if you don't have a lot of money, let's say you got $600 in your pocket, you can go out and you can buy 100 shares of SM, um, and play the game. You're an investor now. You're in the market, you know, and so that can be the reason why we see such a crazy return on this stock. Now, if we were to take out this 152% return, which we're not quite able to do at the moment, but if we were to take that out, we might see a huge drop off in this average. Okay, but because it's there, I do think it's worth looking at. Okay, it's worth looking at, and that's what we're doing. Cheniere Energy is really the winner. It's really best performing in the sector. It really is when you take off this when you take out this outlier. But what we're looking at is Valero. Okay, like I said, Valero. Um, we're being pointed to Valero, best monthly return over the last 3 years. If we take out the last 7 or 8 months, okay, and then ExxonMobil, way down here at the bottom, way down here at the bottom, okay, worst performing company in the entire sector. I mean, come on, worst performing company in the entire sector. And then SM. So let's talk just a little bit about what these companies do, just so we have an idea. Okay, so SM Energy is an oil company. Okay, they're oil and gas exploration. They own a bunch of land in Texas, and they go out and they drill for oil and they drill for natural gas. That's what they do. Very simple, very straightforward. Okay, we see here that their revenue dropped quite a bit, and a lot of this has to do with the price of oil. That's been a huge story over the last couple of years. I remember when I was a kid, well, not so much a kid, when I was a teenager, oil prices were going crazy. There were problems in the Middle East and all sorts of type of things. I remember oil being like $100 a barrel. Now oil is hovering at around about $40 or $50 a barrel. And so this is kind of a new thing, even though it's been this way for the last couple of years. It's still a fairly new thing for the oil companies, and I would argue for the participants in the stock market as well. It's just something that we have to get used to, that oil is going to be much cheaper than what it has been in the past. Not to mention, they're getting oil from different places. I think it was the Trump drill, baby drill. Was that Trump or was that Bush? I forget. But either way, Americans are drilling a lot more oil than what we have in the past. And so there's just a lot more oil on the market. And because there's so much supply, that brings the price down. And then, of course, we have COVID, which has drastically reduced travel. And so jet fuel and all these types of things are just not being demanded as much as before. So I'm sure that we're going to see drop-offs in revenue across the board for these companies. And we see that here. But the one thing that I pay attention to is the net income, right? And the net income has a lot to do with management, because after you take out your expenses for your equipment and all those things that you use to get the oil and store the oil and ship the oil, right? Once you've spent all that, which you ought to know what those prices are going into it, right? Then you come down to things like payroll and travel and those variable expenses that can really be managed, and you really need to manage because they can get away from you. And that's where we get net income, okay? And so when you see these big drops in net income, that a lot of time points to bad management, okay? Especially when you're looking at the difference in revenue and the difference in net income being drastically different. And we'll look at that here in a second. All right, Valero. Now, Valero is strictly gasoline, okay? I think they do own some stores. I'm not 100% sure about that because a lot of times you'll have a Valero gas station, but the store will be owned by someone else. So it's Valero gas, but someone else is selling the cookies and sodas and stuff inside. So we'll just say they're strictly gas play right now, okay? So anyway, so we see a fairly steep drop off in revenue, which again is to be expected because of COVID. And then we see a steep drop off in net income, again, thanks to COVID. That's just the way it is right now in the energy sector, okay? Now, ExxonMobil is a totally different thing, and that's a lot of the reason why we got into it. I believe, I may be mistaken, but we purchased Exxon. I don't remember when we purchased, but when we purchased Exxon, I think it's because we were trying to mirror something of a beta portfolio. Okay, now, I think I discussed that before about another stock that we purchased for our portfolio. But I think we were going after more beta than alpha because I remember doing an analysis between ExxonMobil, I think Chevron or Valero, sometime in the past. I'll have to look back on the YouTube videos and find it to be sure. But either way, ExxonMobil is a different thing because not only do they drill for oil and store the oil and ship the oil, but they also refine it. Okay, so let's talk about this because I think this is just amazing. So they drill the oil, they store the oil, they ship the oil. They refine the oil into gasoline, into oil, into plastics, into all these things. And then they turn around and they sell the gasoline. Okay? They sell the gasoline. They sell the motor oil. They sell, I believe they sell the diesel. I believe they sell the jet fuel. I can be wrong about that, but I know for sure they sell the gasoline. And we all know Exxon branded stores. I followed this company for a very long time. The ex-CEO was in the cabinet of the President of the United States for a while. He's no longer there, but he was there. And, I mean, everything was pointing to ExxonMobil, right? Oil prices fell, and that seemed to just kill their entire business model because unlike Valero, which benefits from lower oil prices because when the oil prices are lower, Valero is buying the gasoline for cheaper and selling it for more, right? But in Exxon's case, they're selling their own gasoline. So lower oil is just lower oil. It's bad all the way around, right? And so that's why we see such a huge drop off in these numbers. But what I want to do is just because if you go back and you look at Valero, I mean, these are huge drop offs too, right? But I needed to really see the math on this. So what I did was, let me see if this is it. Yeah, this is it. So what I did was I took a look at the actual numbers. Okay. All right. So this is 2020 versus 2019. This is 3 months. So this is June to September 30. Okay. And then this is 9 months, January to September. Okay. So the difference between these two, okay, a 28% drop off in revenue. Okay. A 22% decrease in expenses. Now, that's important because remember, we're talking about management. Okay, so when your revenue decreases by 28%, you want to see your expenses decrease by 28%. Because why are you spending the same amount of money to make less money? Doesn't make sense. Okay, that's the management. Okay, that's the cash management. That's where the rubber meets the road. Okay, and then we see the net income loss of 100%. That's crazy. Okay, now we're looking at the full year. Okay, so 9 months from January to September 2019, January to September 2020, we see that there's a 31% drop in revenue, only a 25% drop in expenses, and a 116% drop in net income. Okay, that's huge. Let's take a look at uh, Lero. Where'd it go? Huh, but I had it pulled up. Let's see. Oh, okay, that's why. Okay, so okay, here we go. All right, I didn't do a picture of this one. Okay, so Valero, same thing. 3 months, 9 months. All right, we see a 41% drop in revenue, which is higher uh, than ExxonMobil. Okay, all right. Then we see a 37% drop in cost, which again, that goes back to management, right? They're still spending more to make less. But then we see 159 percent drop off in net income. Okay, and a lot of that has to do with this. Um, Sure, I'm looking at this right. Yeah, yeah, yeah. A lot of this has to do with the looks like hard to tell. Um, well, actually, no. This is just straight up revenue minus cost for the most part. Yeah, they actually got a tax refund. So yeah, I mean, listen, 159% clearly much larger than what we saw over at ExxonMobil. And when you think about it, it makes sense, right? Because ExxonMobil is drilling their own oil, because they are selling their own gasoline, because they are making money on, like I said, refining the oil into plastics and all these other things. Their their revenue and their income is going to be a lot less volatile, more stable. Okay, um, and then we see the same thing in 9 months, 39% drop off. They did a little better with the expenses over 9 months, but then again, we come back to net income. It's 150% drop off. I mean, that's crazy. And so, when you look at that, you say, okay, well, Exxon, as far as their management, or just maybe because of the business model, performed better, actually, performed better than Valero. Look at some other stuff. Um, this is the, uh-oh, I don't remember. I remember. What is this? I think this is revenue, and this is net income, I believe. I'm almost certain of it. And so, what we're looking at here again is we're looking at a 23% drop in revenue, 77% drop in profit versus SM, which has a 21% drop in revenue, but a 268% drop in net profit. And then Valero, 30% drop in revenue, 100% drop in net profit. And yeah, I'm sure about that now because I remember this negative zero point 0.01. So again, when you do the math, ExxonMobil comes out better, and that's why it's so important to do the math because if you just look at the numbers, you know, you see 242 to -01, you're like, well, that's a drop, but but then you see 14 to 3, you're like, well, that's a big drop too, right? But no, it's really a big difference. So again, ExxonMobil, better performing company. All right, let's look at some other stuff here. Now, I talked about institutional holdings previous video, and want to bring that back up now just to make sure we're all on the same page here. Institutional holdings means that these are big banks, big mutual funds, big what's the pension funds, okay, that own shares of these companies. And what many people may not know is that for the most part, most companies are owned by these huge institutional companies. Most companies on the stock market are owned by, like I said, mutual funds, banks, things of that nature. A smaller percentage is owned by like regular everyday people. So what these big institutional investors do really move the price, because think about it. I mean, if I were to purchase 100 shares of Exxon tomorrow, that ain't moving the needle. That's not going to change the stock price very much at all. But if one of these big institutional investors comes in, buy something like, I don't know, 100,000, 500,000 shares at one time, all of a sudden you're going to see the price move. And that's what happens every single day. Okay, so what we're looking at is how much of Valero is owned by these institutions. Let me blow this up a little bit. And so we see that 76% of Valero is owned by these big institutions. Okay, and what we're seeing down here at the bottom is that now, listen, I can't speak to the timing of this, okay? I don't know if this is going to be like last month or last year, but what we can say is, just as a kind of surface level analysis here, okay? 415 of these institutional investors increased their positions in Valero over the course of whatever. I'm going to say less than a year, okay? We can be certain of that. 540 decreased their positions, okay? So 540 of these big banks decreased their positions, which means they sold some shares. 415 purchased more shares, okay? Now, what's also important here is the number of shares. You see that they purchased more shares than they sold. All right? That's important. All right. Take a look at ExxonMobil. Blow this up. Uh-oh. All right. ExxonMobil. Here we go. 818 purchased more shares. 1,500 sold. That's more than double. Well, it's almost double the number of people sold their shares. Now, listen, here's the thing. I have not worked with any of these companies. I've had the opportunity to work with some of these companies and doing the analysis of these stocks and stuff like that. But these big institutional investors, that's what they do. They hire people to come in and do analysis of these companies on a daily basis almost. Okay, when you listen to the earnings calls, that's what you get. You get these analysts that are there listening to the call, and then after the callers are with, the analysts get a chance to ask the CEOs and executives questions, okay? And then those executives answer those questions during the call. And so these analysts, that's their job on a daily basis, is to evaluate and analyze these stocks and these companies. And so again, like I said before, what these institutional investors do matters, okay? And so if you have these institutional investors selling almost double what they're buying, okay, and not really double, I'm going to say 25% more, right? Because they're selling 100, they bought 74. And again, this is over the course of maybe a year, okay? That says something. That says something, okay? Um, do they know more than we do? Of course they do. No question about it at all. I don't have any fantasies in my mind that I know more than what these guys know. So we have to look at this and we have to pay attention to it. And, again, this is looking in the past. That's another thing that's important to remember. These numbers that we're looking at is what has happened in the past. And I can believe it because, again, ExxonMobil, worst performing stock this past 12 months. Is that going to continue? That's the question, right? And that's the reason why this particular sector has been so difficult for me to analyze, and why I spend so much time on it. And I'm going to kind of just, again, go over what I'm doing here as well. Let's see, this one. Okay. This one is ExxonMobil. All right. So we looked at institutional investors. We looked at um, their profits and whatnot. Now what we're looking at is their balance sheet. Okay. The balance sheet talks about what they own, what they owe. Okay. And this is very simple, very straightforward. I'll explain. All right. So I do things a little different than the traditional, um, what I call balance sheet analysis. Okay, the standard textbook balance sheet analysis is going to be a little different than what you'll see here. So I'll explain. Okay, so this is going to be cash, okay, divided by current liabilities. All right, this is going to be something similar to um, the the current ratio that we looked at before. Okay, it's going to be something similar to that. The difference here, though, is that I'm not including the notes receivable. Okay, I'm not including inventories. I'm not including anything that they own. I'm just looking at cash and cash only. The reason why is because I can go in and I can do an analysis on the what's the word I'm looking for? I can do an analysis on the probability of how much of this. Let me blow this up so you can see kind of why it's important here. I can go in and do analysis on the probability of ExxonMobil getting this money, okay? Because notes and accounts receivable means that ExxonMobil has already performed the service, they've already sold the product, but the client, the customer, has not paid yet. Okay, that's just a typical industry thing. Most big businesses are going to have this. Okay, we all understand that everyone doesn't pay their bills, so there's going to be a percentage of this money that ExxonMobil is not going to get. Okay. And I'm not going to try to figure out what that is. Like I said, I can, but I don't think there's a need to. So what I'm looking at is how much of their current bills, okay, that's going to be payroll, that's going to be, rent, leases, everything that's going to be due within a year. So not like debt, not like 5-year, 10-year loans. We're talking about just things that they're going to have to pay within the next year. How much of those bills can they cover with their current cash that they have in their pockets? Okay, and we have that at 15%. 15% of their current bills can be covered with cash. Okay, all right. Next thing we're looking at is solvency. Okay, now I call this liability coverage, but in reality, it's solvency. Okay, and so what I'm doing here is that I'm looking at their total assets, okay? And you can see here what the assets are made up of, all right? Now, one thing that I do, and I've done this in previous videos, is I go in and I really dig into things like other assets and these intangibles, and I really figure out what those real values are, because those intangibles are things like, for instance, the Exxon name. Okay, the name Exxon has a value, right? Question is when Exxon wants to sell that name, what are they going to sell it for? I don't always believe the number that they put down in those books, okay? So I come up with my own number, all right? And there's a bunch of other stuff in there too. There's patents, there's all kind of stuff, right? Now, I highlighted this number here, okay, the plant and equipment. Now, what a company does is they keep track of how much they own. They know how much their building costs. They know how much their machinery costs. And as they use that machinery, as they use those buildings, they depreciate it, which means the buildings and the equipment are valued at less and less and less as they use them. However, again, if Exxon were to sell everything today, all right, there's no way that they're going to be able to sell everything at cost. And I'm not convinced they'll be able to sell everything at the cost less depreciation. I seriously doubt it. It's been my experience that when you have to sell things, you sell them much cheaper than what you purchased them for, because you're trying to sell them fast. And that's what this is about. This is about trying to figure out if this company is solvent. If they sold everything today, can they pay all of their debts, right? Because as a shareholder, I can only get, like, if ExxonMobil went bankrupt today, the only way that I get paid is if they can pay all their debts and have some cash left over. It's the only way that happens. Okay, so solvency, liability coverage, is going to be the total assets, okay, divided by the total liabilities, all of the liabilities. I include everything just because I don't want to leave anything out. If they say they owe it, I believe them. Okay. Now, what this means is that they are able to cover all their liabilities with their assets, and they'll have 0.22 left over. So that 0.22 doesn't mean a actual dollar amount. It just says that they can cover their liabilities plus another roughly 25%. Okay, so that's good. The next thing we're looking at is the dividend payout. So remember, we're investing in these dividend-paying companies. The dividend is important to us. The minute that they stop paying the dividend, we can no longer invest in these companies. So we want to look at that, okay? So what we're doing is we're looking at the dividend for the year, okay? We're looking at the dividend for the year, and we're looking at, based on the cash that they currently have in their pockets. Again, we're not looking at notes receivable. We're not looking at inventories. We're not looking at materials and all this other stuff. We're looking at just cash, okay? Based on the cash they have in their pockets, they can cover the dividend up to 60%. Only 60% of the dividend is covered with the cash they have in their pockets. So what that means is ExxonMobil is, for the most part, obligated to pay a dividend at least this next quarter, but they're not obligated to pay a dividend in the following quarters, okay? And when things get tough, the first thing that the board looks at is whether or not they should continue paying the dividend, because remember, those dividends are profits. Those dividends are money that they're paying out to shareholders, really to be nice, honestly, okay? Because they don't have to. They can easily just not pay a dividend at all, and they'll still receive their salaries, and nothing is really going to happen other than maybe the stock price is going to fall quite a bit. But I mean, based on this past year, I don't think they're even worried about that, because the stock has done horribly. See my point? So the 60% is a bit troubling. Okay, it is a bit troubling. Now, again, if I were to go in and add the notes and accounts receivable, which is, almost double what the cash is, then the dividend is covered, no problem. Okay, that's important to note here. Dividend is covered, no problem. if we add in uh, the notes and accounts receivable. And like I said, we know that they're not going to get all of this, but they'll get most of it, I'm sure. Take a look now at Valero's balance sheet. Okay. So same thing. 49% of Valero's current liabilities can be covered with the cash they have on hand. Much better than ExxonMobil. Okay? They are solvent. Okay. And this is very similar to ExxonMobil, which is almost 20%. Valero's 30%. It's a little better, but not much. And then the dividend coverage, they can cover it damn near 3 times over. So they have plenty of cash to cover their dividend. No worries at all. And so, again, the reason why this is so difficult is because we're looking at two companies, two different business models. Um, ExxonMobil, because of their business model, um, has performed better as far as earnings go, right? But the stock is trash. Um, Valero, on the other hand, um, has performed worse as far as earnings go. Right? They're losing money, you know. Um, um, but they have a lot more cash on hand to handle everything. Their dividend is much more sustainable. Then the other thing is, let me blow this up, is when you take a look at the receivables for Valero. Okay, there we go. When you take a look at the receivables for Valero, I mean, look at this. ExxonMobil was more than double what the cash was. Valero is about the same. So what that means is like when you talk to someone and they say, "Oh, don't worry about it. I have cash coming," right? I mean, if their credit is good, you believe them, right? But at the end of the day, no one wants to hear that. No one wants to hear you have the cash coming. I want to hear you have the money. You know what I mean? So Valero seems to be a safer play, even though um, looking at, like I said, the earnings, um, they're not doing as well. But again, that's because of the business model. So, I mean, honestly, I'm not sure where to go with this. In all honesty, I really don't. Um, you know, like I said before, what the uh, big guys are doing matters. It does. Um, uh, but it's also important to remember again, this is looking back in the past. This is what has happened. Okay, and keep in mind the reason why the market is a market is because you have differing opinions. You have a bunch of people that's selling, but you have a bunch of people that's buying too. And I think the one thing to look at as well is that even though you have almost doubled the number of people selling, they're selling less than the people buying. Or we can say that there's people buying more shares than there are people selling shares, if that makes sense. There's more people buying shares than there are people selling shares because there's more people selling, but they're selling less, right? And keep in mind, this means that they are decreasing. It doesn't mean that they're completely getting rid of ExxonMobil as a position. It just means that they're selling some of their shares, right? Um, so again, this is what makes it so difficult. What I want to do quickly is take a look at just kind of the side by sides here, um, and know that I've already seen my notes. don't remember how many companies we have. Let me say, yeah, and there's a bunch of companies in the energy sector this year. Um, let's look at Cheniere. Followed them for quite some time. They're interesting. I'm not throwing them in there because they're there. But okay. So number one, let's just look at the price performance just overall. So purchase price 80, the current price 55. Horrible, right? Okay. Cheniere is much better. 26, 23. ExxonMobil 75, 41. It's crazy. SM 11 and 6. Again, crazy. But that's the energy sector this year. It is. PE ratios don't matter simply because most of these guys are losing money. And so when you have negative earnings, you don't really have a PE ratio. Matter of fact, if you were to try to put this into a calculator, it's just not good. There's just no such thing as a negative PE. ExxonMobil, however, has a positive PE. Why? Because ExxonMobil actually turned a profit, which again is thanks to their business model. They're doing everything. They're drilling the oil, selling the oil, everything. All right. Look, Valero, a lot more cash. We've already looked at that. Again, they can cover their dividend 5 times over. A lot more cash on the books. The short interest in Valero is fairly high. And that's interesting, especially based on what we saw with institutional investors. Valero has a much higher alpha. And we're talking about when things open up and travel gets back to normal, Valero is in a prime situation to make a whole bunch of money. And that's what that alpha stands for. Okay. Now, the interesting thing is, these numbers are just numbers, right? They're just statistics. That's it. They just look at past performance and they come up with a number. And what we derive from that number is what tells the story. And so when you think about, again, who Valero is as a company, what they do, what their business model is, and then you overlay that with the alpha, all of a sudden it makes sense. It's like, oh, well, that's why the numbers are the way they are, right? Of course, this is the alpha play, In this case, we haven't talked a lot about the up moves and down moves, but in this situation, I think it matters because we're looking at Cheniere and ExxonMobil are right there. SM is horrible, and then Valero is way up. And just to go back to what an up move is when there's a lot of buying and selling activity, this particular stock tends to go up. And the price tends to move up when there's a lot of activity. Okay, and then with the down moves, it means that when there's a lot of buying and selling, the stock tends to move down. The price tends to go down less than, relatively less. Let's just say that, relatively less. And so it makes sense that with ExxonMobil, right, because of the business model, that stock price is going to move a lot less than what you would have with Valero. But interestingly enough, the beta is the same. Okay, remember, beta is based on what happens when the market is doing horrible. These companies perform better. And because we have negative betas, what that means is that these companies perform a little bit worse than the market when the market is doing bad. Okay? Cheniere Energy actually performs better when the market is doing bad. Okay? And then, of course, we have this 3-year average monthly return. And Valero just kills the rest of the group. Okay? The other thing to look at here is volatility. Okay, we talked about that, the standard deviation. That's just how much the price moves around, how far up, how far down. And of course, ExxonMobil, again, because of the business model, moves around a lot less than the rest of these companies. A lot less. Um, oh, and then again, we get the M score. Valero's going to, of course, be at the top because of all the cash on the books. Um, you know, the thing is I'm a numbers guy. Um, I like to look at numbers and go with numbers. And in situations like this, you can't, you can't just go with the numbers because if you go with the numbers, ExxonMobil seems like the better company, even though Valero seems to perform a bit better. Let's take a look really quickly at actual performance. And yeah, I mean, listen, man, Valero has been in the best performing portfolios. It's better price performance. It's poised to really jump when we have things open up, which will happen. I seriously doubt things will get. I mean, listen, if things get worse before they get better, they're still going to get better. I think it's kind of what I'm saying here. It's hard for me to say that because I don't know, right? But yeah, if things get worse, they'll eventually get better. The worse things get, ExxonMobil's in a better position. However, the better things get, Valero's in a better position. So, with that said, we're going to go into Valero. But bringing up the cash management situation again, we have to sell our position in ExxonMobil in order to purchase a position in Valero. Depending on what kind of cash we need to invest in Valero, really depends on kind of how that happens and when it happens. So that's something that I think I'm going to hold off on for maybe a day or two. But I'm definitely going to sell out of ExxonMobil, and I'll wait to initiate a position in Valero.